Hello friends, welcome to Business Hologram YouTube channel. Today we are reviewing the company FlySBS Aviation Limited. First, I will give an overview of the company. FlySBS Aviation Limited is a premium non-scheduled air charter service provider headquartered in Chennai. The company caters to a niche elite clientele, including corporations, high net worth individuals, diplomats, and celebrities, providing both domestic and international private jet chartering services. The company transitioned into a public limited entity and listed its shares on the NSE platform in August 2025. So let's look at the key market indicators of the company. So the current stock price is 413 rupees per share. Market capitalization stands around 730 crores, which falls into a small cap company. If we look at the 52-week price range of the shares, the lowest price reached was 355 rupees, and the highest price touched is 790 rupees. As I already said, it was listed on August 2025. Its IPO was on August 2025. Now let's look at the business and operational model of its company. So the first is their core service, that is the private jet chartering, tailored flight itineraries, long-term luxury charter programs, corporate travel solutions, and specialized emergency air ambulance services. So regarding the DGCA approval, the company holds a valid air operator permit issued by the Directorate General of Civil Aviation (DGCA) as a non-scheduled operator. So if we analyze the fleet strategy, FlySBS initially operated via a wet-lease quasi-quota framework, where the lessor provides the aircraft along with the crew, maintenance, and insurance. To improve operational control and margins, the company transitioned to a long-term dry-lease model, under which it operates its primary asset, which is a 13-seater Embraer Legacy 600 business jet. They supplement their fleet by utilizing aircraft like the Dassault Falcon 2000, Bombardier Challenger 605, and Bombardier Global 6000 on an as-needed basis. So if we look at the geographic reach, we can see that it is operating out of major Indian hubs, including Chennai, Delhi, Mumbai, Bangalore, Hyderabad, Coimbatore, Cochin, etc. The company dynamically flies to destinations across 6 continents. Out of its total flying hours in FY 2025, a significant majority were on international routes. Now let's look at the financial performance of the company for the last 1 year. Since the company is listed in the NSE SME platform, FlySBS Aviation Limited follows a half-yearly reporting cycle rather than a traditional quarterly one, which is standard regulatory practice for SME board companies in India. So as you can see in the screen, we have listed the half-yearly financial performance of the company for H1 FY 2026 and H2 FY 2025. The available data outlines a massive jump in both operational revenue and profitability following the deployment of their capital raised via the August 2025 IPO. The other key takeaways we get from the data is first is the IPO. Of course, as I discussed, the IPO catalyst. The H1 FY 2026 revenue of 140 crores represents a massive 40% growth compared to H1 FY 2025. This surge was primarily driven by the long-term dry leasing of their pre-owned aircraft funded by the IPO proceeds, allowing them to capture higher flying hour volumes. Next point is a net profit explosion. Net income for H1 FY 2026 stood at 23.84 crores, exploding by 122% year on year relative to the identical half-year period in 2024. Next is margin maintenance. While operating margins experienced slight fluctuations due to initial entry into service cost for dry leased jets and volatile aviation turbine fuel pricing, the overall net margin stabilized at a healthy 17%. Now let's look at the strategic initiatives of the company. To build on its market position following its 2025 public listing, FlySBS Aviation Limited has structured its strategic roadmap around asset optimization, fleet expansion, and tapping into high-margin international operations. So we will be focusing on major five strategic initiatives of the company. So the first focus is on structural transition from wet lease to long-term dry lease. Historically, FlySBS relied on an asset-light, quick-to-scale wet lease model. That is wet lease model is paying external lessors for aircraft, crew, maintenance, and insurance. To capture higher margins and establish complete operational control, the company is systematically shifting to a long-term dry lease model. We can clearly see the effect on the margin by leasing just the hull and managing crew training, flight planning, and fuel allocation internally. The company successfully expanded its EBITDA margins from under 10% to over 22%. So the next major strategic initiatives of the company is fleet aggregation and capital deployment. The cornerstone of FlySBS near-term growth is the rapid deployment of its 102 crore IPO proceeds. First is their targeted aircraft acquisition. The company earmarked approximately 78% of the capital raised strictly for the acquisition of 6 pre-owned mid to large business jets via long-term dry leases. Next is the Legacy 650 induction, marking a major milestone under this strategy. FlySBS officially introduced a 13-seater Embraer Legacy 650 business jet into its fleet. The mid-size jet offers extended range capabilities, directly unlocking long-haul route capabilities. So the third strategic initiative of the company is aggressive international expansion. FlySBS is actively positioning itself as a global private charter partner rather than a purely domestic player. So their focus is on global route footprint. During its initial scaling phase, international operations accounted for roughly 70% of the company's total flying hours. So the next focus is on high margin sectors by centering its network around routes connecting India to destinations across 6 continents. FlySBS targets the ultra high margin segment of corporate cross border travel, international diplomacy, and global luxury tourism. So the fourth major strategic initiative of the company is vertical integration of airworthiness and MRO. To safeguard fleet uptime and manage strict aviation safety regulations, the company has heavily invested in internal infrastructure. So their first focus is on in-house CAMO. FlySBS achieved continuing airworthiness management organization CAMO approval under CAR M compliance from the DGCA. This allows their internal quality management team to oversee continuous aircraft health monitoring rather than outsourcing it. Also, their focus is on strategic MRO partnerships. The company locked in long-term service agreements with a premium DGCA approved maintenance, repair, and overhaul facility in Bengaluru to ensure quick turnaround times, minimizing the costly downtime of its dry leased corporate jets. So the last or the fifth major strategic initiative of the company is capturing air logistics and shared ecosystem growth. FlySBS maintains strong corporate links and shared directorships with Afcom Holdings Limited, an established player in the international air cargo service. So their focus is on strategic alignment. While FlySBS handles the premium passenger charter end, its cross linkages allow it to build synergies within the broader air logistics supply chain, navigating dual regulatory clearances and airport ground handling networks with greater efficiency. So the strategic takeaway is FlySBS primary goal is leveraging high entry barriers in the DGCA non-scheduled operator space by deploying IPO cash to move away from expensive third-party wet leases and establishing an absolute monopoly over its operational supply chain. They are prioritizing steady, recurring charter hours from corporates and HNI clients. Now let's look at the ownership structure of the company. As you can see in the screen, the promoter and promoter group holds 32% of the shares. Public and non-institutional investors hold 64%. Foreign institutional investors 2%. Domestic institutional investors 0.66%. So the key takeovers include the promoter group holds a combined 32.4 percentage, which has remained entirely locked in post listing with zero shares pledged or encumbered. So the major promoters include Captain Deepak Parshuraman, Shrestha Business Solutions LLP, Krishna Raj Jain, and some other insiders also are part of the corporate promoter group. Next, if we analyze the institutional and public float structure, we can see the FII footprint. While small cap SME listings rarely attract large global funds early on, FlySBS retains a modest 2% foreign institutional holding. The primary institutional anchor here is the same capital fund, which commands a flat 2% ownership block. So next we can see that the non-resident Indian concentration. Interestingly, the public category features an unusually high exposure to NRI investors, who owns roughly 11.7 percentage of the company. A key non-institutional individual investor in the pool is Ritu Bapna, who holds a prominent 4.87 percentage standalone stake. So next is the retail and HNI distribution. The remaining public float is split almost evenly between traditional retail investors holding individual lots. 19.62% goes there, and high net worth individuals or corporate bodies holding larger ticket sizes above 2 lakhs, which includes 26.75%. So if you look at the governance and takeaway, at 32.4 percentage, the promoter holding is is on the lower side for a freshly listed Indian SME company. However, because of massive 60 percentage of the public float is locked into fixed blocks by long-term HNIs, NRI investors, and small corporate bodies, the active day-to-day trading float is highly concentrated, which explains why the stock experiences low overall liquidity on non-reporting days. Now let's get into the financial ratio analysis part. First, we will begin with profitability ratios. As you can see, the operating profit margin, the company's value stands at 23%, where the industry average is 12 to 15%. So clearly, we can see outperformance of the company in this aspect. Next is net profit margin. The company's value stands at 17.03%, where the industry average is 4 to 6%. So in this aspect also, the company is maintaining an exceptional figure. Next is the return on capital employed, ROCE. The company's value stands at 34.67%, where the industry average is 16 to 18%. So it is outperforming in this category also. Next is return on equity, ROE. The company's value stands at 26.23%, where the industry average is 13 to 17%. So strong growth is seen in this aspect also. Next, if we look at the return on assets, the company's value stands at 16.2%, where the industry average is just 5.526%. So clear outperformance in this parameter also. Now let's look at the values of the leverage ratios of the company. First is debt to equity ratio. The company's value stands at 0.12, where the industry average is 1.8 to 2.5. So it's maintaining an outstanding outstanding figure in this aspect. Next is interest coverage ratio. The company's value stands at 19.58, where the industry average is 1.5 to 3.2. So it's highly secured. If we from the interest coverage angle, the company is highly secured. Now let's look at the valuation ratios for the company. So the first is the price to sales ratio. The company's value stands at 2.69 to 3.69, where the industry average, which is the Indian aviation peers. We'll take the Indian aviation peers for consideration to get the industry average. The industry average stands at 2.06 to 3.09. So the company is fairly valued in this scale. Next is price to earnings ratio. The company's value stands at 25.1 to 29.5, where the industry average is 36.5 to 40. So it's attractive. The share is attractive from the price to earnings angle. It's undervalued also. Next is the price to book value. The company's value stands at 2.83 to 2.9, where the industry average is 6.74. So it's highly attractive from price to book value aspect side. Now let's do a quick SWOT analysis for the company. First, we will be looking at the strengths of the company. So, first strength of the company is a high entry barrier space. Operating under a strict DGCA non-scheduled operator permit requires navigating severe regulatory clearance, asset vetting, and hefty multi-million dollar deposit requirements, protecting FlySBS from quick low-cost competitors. So the next strength is the structural transition to dry leases, moving away from expensive third-party wet leases to managing their own hull leases has directly expanded their net profit margins to an industry-beating 70.03%. Next strength is clean, low leverage balance sheet. Backed by their 102 crores IPO infusion, the company operates with a virtually debt-free balance sheet. This structural cash buffer insulates them from domestic interest rate cycle volatility. So the next strength is strategic operational synergies. The shared promoter linkages and structural overlap with cargo freight operators like Afcom Holdings provide shared ground handling efficiency and speedier international flight clearance routing. Next, we will check the weaknesses of the company. The first weakness that we have identified is extreme client concentration. The core business model relies entirely on ultra high net worth individuals, corporations, and political executives. Any temporary slowdown in luxury discretionary spending immediately impacts charter hour volumes. Next point is heavy initial capital intensity. Expanding an aviation footprint demands huge upfront outlays even on a dry lease model. Security deposits, entry into services overhauls, and continuous compliance require deep working capital reserves. Next point is negative operating cash flow friction. Because rapid fleet aggregation requires upfront outlays for maintenance overhauls and global lease deposits, the company's rapid expansion has historically outpaced its immediate operating cash generation. Next, we will check what are the opportunities in front of the company. First one is a bespoke corporate migration out of Tier 1 hubs. As industrial expansion and premium corporate headquarters spread rapidly into India's Tier 2 and Tier 3 cities, the lack of traditional commercial airline connectivity directly drives localized demand for private corporate charters. So the next point is geographic target range expansion. The recent induction of longer range business jets opens up seamless overhaul routes connecting India directly to regions like Europe and the Middle East and the Far East without multiple refueling layovers. Next opportunity in front of them is event-based luxury tourism vectors. The explosive post-pandemic rise of elite experiential travel, high-profile multinational sporting events, and ultra-luxury wedding destination charters provides high ticket recurring season pools. Next, we will check the probable threats in front of the company. The first one is aviation turbine fuel volatility. Fuel represents the single largest variable component of flight hour expenses. Geopolitical disruptions that spike global oil benchmarks put immediate pressure on operating profit margins. Next point is stricter regulatory and carbon emission targets. Emerging international aviation guidelines regarding carbon offsetting, sustainable aviation fuel mandates, and domestic DGCA airworthiness monitoring modifications can enforce unexpected operational changes. So the next point is SME board market liquidity constraints. Listing on the NSE SME platform inherently subjects the company to tight daily trading loads and thinner institutional volume support, creating stock price volatility on minor macro shifts. So friends, that was a short review of the company FlySBS Aviation Limited. So if you have found the video useful, please like, subscribe, share, comment and support. Thank you.